I have a very distinguished panel here in front of me and very interesting topic at hand. Smart capital for small businesses. How can lenders catalyze the new age MSME growth story? Since past 2 hours, we've been discussing the importance of MSME and MSME lending. MSME has been over last decade or so come out as a backbone of Indian economy. It's not only the MSMEs which are getting into innovation, but I think they're supremely critical for the employment generation that they're doing for our country and in our path towards Vikasit Bharat. We realize that MSMEs are evolving, and they are evolving as far as innovation is concerned, as far as digitalization is concerned. And at the same time, when the MSMEs are evolving, I think the financial institutions are also evolving in terms of newer ways of credit underwriting and various other newer opportunities. So that's what we're going to discuss today. As MSMEs evolve, so the lenders, right? So thank you all, my fellow panelists, and thank you for your time. Let's start. Let's begin the discussion. So, Kalyan sir, let me start with you first. So, my question to you is, as India's economy evolves, new MSMEs are emerging across manufacturing, export, digital commerce, and services. Particularly, which MSME segment or sector are you the most bullish on from the next few years point of view? And which sector is kind of driving your credit growth strategy?
Thank you for the nice question. Actually, you are right. MSME is the main growth engine for Indian economy, contributes 30% to national GDP. And also with the 7 crore registered MSME enterprises, and in export also more than 46% contribution is there. 25 crore people are employed here. No doubt, lot of growth is there, and still lot of opportunities are also available, because if we see till now Udyam registered companies also, if you see, only 47% of them are active now. We can see the headroom available to all of us. There was one survey, whole MSME market is 110 to 120 lakh crore. Out of that, from institutional finance, only 30% approximately are from the formal financial system. Still 55-60 lakh crore are unmet demand in this MSME segment. What I mean to say, no doubt, lot of things have been done, but looking to the opportunities of growth available, it is the main growth engine, not only for Indian economy, not only for in terms of employment generation, but also as a public sector bank head, I can tell you, this is also very important growth engine for our overall credit portfolio. Now coming to the preference for Central Bank of India, or actually, there I would like to say our MSME has grown by more than 70% year on year in March end. And our major focus area was actually, first I will talk about manufacturing. In manufacturing sector, it is also a very important growth engine for Indian economy. We identified 225 MSME intensive branches in the active clusters. And directly, whole credit underwriting, from credit underwriting to monitoring to collections, everything was properly digitized, and active participation in the clusters growth and all. This was one area in manufacturing sector we did. Second, in export side also, we have in manufacturing side also specific products were designed looking to the cluster specific products, which was actually really having very competitive rates were available. In export side also, actually, as I told, that 46% contribution of MSME in export segment, and a lot of MSME units. I will give you one example. In last 5 years, from 50,000 to 1,70,000 units are in export sector. Lot of growth opportunity here also it is available. For that purpose also at Central Bank, we have devised several schemes like Cent Export, and also supporting them for not only for preparation for export, but also post-export side also. There is centralized Forex cell, where through our portal they have ease of actually, they are very conveniently sitting at home, they can send their invoices, they can send, complete the remittance processes and all the export related work. So that is one area. Manufacturing side also, our focus area is there. Third important segment is services. Due to reclassification of MSME and all, more and more small entrepreneurs and small businesses have come into the ambit of this services side. Here, I will like to tell you, highlight what Central Bank of India is doing. Actually, you know, even though they are actually registered under Udyam, but still they don't have proper advisory support. So there we have, uniquely we have devised one product that is Cent Sarthi, we call it. And in Cent Sarthi, there are 4 pillars of it. One is for a smaller segment, majorly micro segment and a small segment, majorly it is there. There what we do, we, through our network present across the country, we conduct the clinics and promote them for getting registered under Udyam. And thereafter benefits of Udyam, then we provide them skill-based training. And also like means consultancy-based on technology platform. On pilot basis, we are providing them advisory also for getting right kind of skill set, right kind of machinery, right kind of guidance for taxation, GST related issues, the bottlenecks which are available due to which they are not able to take the advances or finances. This was the first step. Second, regarding financing side also, there is one platform, integrated platform, where all the facilities available there to avail the finances automatically on digital based. Up to 25 crore Central Bank of India provides through digital mode. That is cash flow based lending. And third is marketing support. Fourth is also, if suppose unit gets stick and some stickiness is there, then how to revive them, how to restructure them. With end-to-end these 4 pillars, this Cent Sarthi is actually really supporting us in growing towards the services sector. So our major focus area, if I can summarize, actually all the ancillary units supplying to the major units like defense corridor, like also several food processing segment, warehousing, logistic, data center, green energy. These are the major growth drivers for Central Bank of India.
Wow. Kalyan sir, thank you for those insights. They're really impressive numbers and very thrilled to hear the market development work that Central Bank is doing in this MSME segment. Let me bring in Ashish here. Ashish, I have a question which is very pertinent to Northern Arc. We realize that no single institution actually can serve the fully an MSME today. And increasingly, partnerships, whether it is fintech, platform, ecosystem player, are playing a very, very pivotal role in shaping the credit landscape or credit delivery. Audience would like to know, Ashish, how critical are partnerships going forward? Are they here to stay? Are we moving towards a more embedded, ecosystem-driven model on MSME? Sorry.
Thank you, Nikhil. Good to see you in the new avatar.
Thank you.
I think the Kalyan sir has put a perspective. Our own estimation was the credit gap of about 50 lakh crores if you adjust for the GDP. But if the number is larger, that means the opportunity is bigger. I think Nikhil, you rightfully brings out the perspective. No single institution can do it. I think, and the way the evolution over the last 10 years, 2 important pillars for this conversation. One is on the UPI, and I want to talk about ULI, Unified Lending Interface, what can happen. The first is, how do you bring all the constituents in the RE universe, in the regulated entity universe, to make the credit delivery happen? I think what we've seen, and Northern Arc's been at the forefront of what we've been doing for last 15 to 16 years, 2.5 to 40 trillion of credit enabled, is that the banks, you have can leverage the bank's might and balance sheet to provide access. NBFCs brings the agility and the reach to the last mile financing. The platforms brings the data integrity, the quality, and you combine all of that capability under the ULI framework. This means you have an access to the data, you have access to the bank statement, to the account aggregators, to the KYC, to the GST records. This means you can deliver the credit at the point of transaction rather than a small micro enterprise or an emerging business working through the banks for working capital limits and term limits. The entire credit landscape, to my mind, in the next 5 to 7 years will change, and embedded finance will take over to the entire ecosystem. The entire working capital cycle then can go away with the transaction-less based credit available. We've seen the transformation of that in the personal finance space, correct? I think that, to my mind, is going to happen. That means the banks and NBFC partnership becomes important. The co-lending partnership becomes important. The technology stacks become very important. And that, to my mind, will significantly transform and make access to credit far more reachable. Today, that number is actually painfully lower than 30% of 7.5 lakh crores registered Udhamadar users. So I think that's the big piece. And that's why consciously Northern Arc's being investing in it. We run a platform called NPOS. We underwrite about 30,000 loans on a real-time basis, connecting, engaging. And the third point, it is product agnostic. It can do personal loan, it can do a LAP, it can do a housing loan, it can do a vehicle finance. I can do every product on it. So I'm truly, in the ULI framework, if you use technology rightfully and bring the entire product ecosystem at play, you have a MSME-led credit solution business, which is embedded finance, which is hitherto used to be product-based. For the first time, we are looking at, and from the environment we come from, we used to talk of client centricity and all of that, that you build the products, but the entire ecosystem, the solutioning comes on a partnership with all the constituents coming together. That's my take here.
Wow. Thank you, Ashish. That's a very, very powerful perspective you've given. Indrajit, now let me bring you in the conversation. My question to you, Indrajit, is as MSMEs are increasingly participating in global supply chain and cross-border commerce, in your, where you sit, right, which are the new risks and opportunities does that create for lenders is my first question. And, how should the credit models adapt to a better support to export-oriented industries specifically?
Thanks, Nikhil. First audience, let's get the perspective here. India is an MSME country. We possibly have the largest number of MSMEs. Why I'm saying possibly, because the second country is very close to us. It's not United States, it's Indonesia. We have 8 crore registered users, they have about 7.2. 31% of our GDP on nominal basis is MSME driven. Like so, you said 46% of exports, 32 crore people employed. It's a huge industry. And this is the industry which actually has to blossom for India to reach the goals of 2047, which our country has set for itself. What does the MSME person, okay, my bank lends primarily to MSMEs. More than 60–70% of our lending is to MSMEs. So for us, they're the mainstay. What does the MSME person actually need or want? It's actually quite simple. The person needs trust that when he puts up a bill, he will receive the money. The person needs efficiency, that when he needs money, it will come in reasonable time. And the third thing he says, give me good rates also on lending and foreign exchange conversion. That's it. 3 simple things. Give me the trust that you'll do it for me, give it to me in time, and charge me a reasonable rate. Nothing extraordinary. I think we have our pants in a twist trying to solve this simple dilemma. Let me, Nikhil, first answer what advantages the banking system collectively here and most of us in the financial industry have. The first thing we have by solving this problem is empowering supply chain finance, not just India, but cross-border. Cross-border is even more important because the person on the other side is an even more mysterious entity. The second part of all this is what Ashish has talked about is embedded finance. To simply put it, no long credit memorandum, no 90 days assessment of the customer. Use a platform like Threads, which all of us understand, or a similar platform. Person puts up a bill, use your methodology to understand his assessment, and if it fits your system, give him the money. The third part of this is basically very valuable. When we export, we are not looking only at India. We are looking at the standards of the other country. And we mostly export to countries which have tighter standards than us. So we have to go for green financing, compliance to ESG, climate norms, which forces our MSMEs to have better quality of equipment and a tighter check on quality control. This is where banks in India have to come in. Finance him for all that, not just the transaction of the bill or the transaction. Give him pure finance on improving his quality of asset which he's actually exporting. The third part was, what are the risks? Or tremendous risks. Risks which banks and financing institutions understand, but not the MSME person necessarily. The first is, of course, the exchange rate risk. It's a simple solution to everyone in this room. You hedge the principal, you hedge the interest rate, you're fine. You pay a little premium, but you're going to get your money in time. The second risk you actually have is a little more complicated. It's a tariff risk. I'm not trying to bring Donald Trump in here. Tariff risk and ESG risk. When you send to Europe, Australia, Americas, they actually evaluate a product based on all this. Have children been employed? Have you destroyed trees? How have you managed to actually manufacture? Is it something which can be sustainable? So the product, when it reaches there, should not come in for a surprise. That's why we in India have to provide the advisory which Kalyan sir was talking about. The third risk, which is very long and large, is the delay of payments. Delay is like a, it eats into your working capital. You run out of capital, you run out of time, you end up paying interest. So that has to be shortened. Having given the advantages, why we should do it, and the risks, what the MSME person needs to protect, Nikhil, my submission is that it is an ownership issue on our part to provide the MSME a solution which actually brings the two together. We have to get away from asset-based finance. At the moment, we fund what the person is exporting, and that's what causes the real problem. We have to get into cash flow-based advancing. Only on that basis, electronic digital settlement methods can actually come in. So very simple mantra, we have to get away from the asset-based financing and get into cash flow financing. I will quote something very interesting which I heard today morning from the chairman of TransUnion CIBIL. We have to use things for proxy of what the person actually earns. He talked about how much we pay to Uber and Ola and about hailing, sharing cabs. Actually, both Indonesia and Singapore do that. They go to an app called Grab and see how much a person spends on a monthly basis and says this is a proxy of his income. Thank you, Nikhil.
Thank you. Thank you. Pearls of wisdom. Rajiv, coming to you. With increasing digitization on financial and non-financial data, especially GST, account aggregators, and so on and so forth, how do you see alternate data shaping MSME risk in terms of assessment, right? And what do you think are the limitations or risks that are still need to be addressed as far as alternate data is concerned?
Nikhil, thank you, and thanks for TransUnion CIBIL for having me and our organization here. And I also want to take this opportunity to thank everybody in the audience. Clearly, you guys genuinely care about what we have to say. So really grateful that you all have taken the time to be here in the audience. I think the folks before me have actually laid out what you're seeking, right? We will move from looking at simply collateral or documentation, which is what we were doing for a while, to now looking at cash flow, looking at behavior. How do we assess that cash flow behavior? There are multiple sources of information now becoming available. ULI that Ashish mentioned, the account aggregator that Indrajit mentioned, the business rule engines and the automated way in which Mr. Kalyan mentioned they are processing. These are all great examples of the real opportunity in terms of the transition. And more sources of data that get integrated into this, the more robust the underwriting, the ongoing management, and so forth will be. Speaking for Sundaram Finance, 100% of our portfolio is MSME. 90% is MSMEs that own vehicles of some sort. 10% is what we call beyond wheels. And in many ways, in the 72 years we've been around, our entire existence has been based on cash flow assessment and behavior assessment, not so much documentation or collateral. Those were sort of incidental. So this tectonic shift that technology, data, and digital is doing is actually working against us. So in a sense, for us, the imperative is to wake up to that reality. But I do want to address the second part of your question, which I think is perhaps where the real set of challenges that we as an industry have to grapple with, and perhaps some of the lessons that we have learned. Looking back at our 72 years, there's perhaps over 1 crore MSMEs that we have served, and most of them have been successful and moved into the formal banking system, and much of them are now customers of the banking system. So in many ways, looking back at our journey of graduating people from the financially excluded segments to the financially included segments, there are some lessons to share. 2 or 3 I'd like to point out, right? The fact that data is available does not mean that the individual is creditworthy. There is a ton of information that might look very good, but that good information, whether it's GST filings, income tax filings, any bureau trades, so on and so forth, doesn't translate necessarily to resilience. And frankly, over a long period of time, resilience is what matters and not a point-of-time estimate of the creditworthiness. So I think that's one risk that all of us have to build our muscle around, which is leverage all this alternate data and capabilities that are available, but really begin to look at what the resilience of that individual borrower looks like. Second, good data or strong data doesn't translate to good intention. And so while ability is important to assess, intention is equally important to assess, and giving money away is very easy. The trick is in collecting it back. And so how does one calibrate intention in a data-rich world where all the pointers seem to suggest a terrific credit, but intention is actually under the radar, something that we are not able to assess. So I think that's another important risk that we need to keep in mind. Third, I would say, is this richness of technology and data heightens scamsters, right? And so the ability to forge RC documents or invoice documents in our business, or forge a machine invoice, goes up significantly. So how do we put smart capabilities to ensure fraud risk is prevented? And lastly, perhaps the biggest challenge, I think there were very powerful numbers that all the speakers before me outlined, right? The potential is immense. If there are 8 crore MSMEs, 30 odd crores employed by them, if you just parse the numbers, that translates to 4 employees per institution, right? And that's relatively small. And if you include the unorganized, unregistered segment into it, that 4 employee base probably drops to 2. So it's basically a husband, wife, or father, son that are operating the average MSME. And our responsibility is to ensure that that average MSME actually graduates. And if you parse the MSME landscape, there was a very interesting commentary in one of the annual economic surveys that the chief economic advisor put out a few years ago. I think the MSME landscape has 3 categories of players. I think there are maybe a third of them are what was characterized as children. Children are small, but will grow. About half are actually dwarves. These are small, but will never grow. The balance, 20-25%, are crooks. So in a sense, what we have to do as responsible lenders to build the system is to A, eliminate the crooks, B, force the dwarves to either become children grow or merge with other dwarves to become children that will grow, and really ensure that the children reach their full potential. If we're able to do that, then Indrajit and Prime Minister Modi's vision of Viksit Bharat, we can do even sooner than 2047, right? So I think the confluence of technologies, alternative sources of data are powerful. But how we end up using it responsibly, I think will direct how we make progress as a country. It's very easy to get trapped in the intoxication of delivering credit and growth, right? But getting the money back, ensuring the customers are growing is, I think, the primary responsibility.
Yeah, absolutely. Very, very important perspective. And Rajiv, thank you for that. Sachin, I have a question which is, I'm assuming, would be close to your heart. A large segment of MSME, particularly logistics, transportation, last mile delivery, are closely linked to commercial vehicle transporters. And many of whom have a seasonality in their business, right? Cyclical businesses or cyclical cash flows. My question to you is, how should lender rethink the credit assessment and product design to effectively serve this particular MSME commercial vehicle ecosystem, while at the same time managing the seasonality or volatility around it and ensuring the asset quality maintains?
Yeah, hi. Good afternoon. Good evening, rather, to all of you. Thank you for having me on this panel today. Yeah, this is close to my heart and maybe closer to somebody who's sitting to left to me as well. So yeah, very much so. So yeah, I know if I look at it and I'll be specific to commercial vehicle operations here, because many of us on the panel has already covered the larger or macro picture of MSMEs. In our scheme of things, if I have to look at, from a CV ecosystem perspective where we are present today, it's largely, as an NBFC, we are more focused on to the small road transporters and retail operators, which typically will be 3 to 5 owners owning MNCVs, 3 to 5 numbers of that, which possibly deployed in the regional corridors across the country. You have then your LCVs and ICV operators, which are kind of deployed within the state, and by definition, there is nothing called as fleet out there. And then you got the last mile connectivity. So that's where, the ecosystem is today. And over the period, we have seen that, this entire, customer segment, by virtue of the way the operations are largely informal and, unorganized in that sense. You don't get formal credit inputs out there. So by default, we all financiers who have been in this segment have kind of, developed our, I would say surrogate or, not informal credit matrices around that. And that's how we have been appraising, and underwriting these customer segments. So in a way, what others were mentioning to be done for MSMEs in other categories, CV has been this segment has been kind of, underwritten and it's quite evolved in that sense today, the way, informal credit surrogate-based underwriting which has happened. And as, Rajiv was mentioning, with the human interface, it's not only about data out there, there is a lot of human interface which comes in when, when you look at underwriting a commercial vehicle customer. Over the period, obviously, there have been refinements which have happened from a systemic basis and which has only helped us further evolve, on this side. One obviously has been the way, GST has come into play right now. So even if you look at it, a small 3-vehicle customer who possibly, runs in the, applies a vehicle in the Delhi-Ahmedabad corridor would end up earning somewhere around 3 to 4 lakhs per vehicle per month, which essentially means at the end of the year, he is within the GST ambit. Now, how much of that gets reported, etc., is separate, but with the 20 lakh threshold, definitely is within the GST. So there is a formalized, credit, input which is coming in, which otherwise in the erstwhile period, it was not there. The second, I would say improvisation which has happened is over the last few years, we have seen quite a bit of aggregation happening on the freight side through the online platforms and digital platforms which have come in. We also have one Grow digital platform, which is a 50-50 between Ashok Leyland and us, where currently in our 4th year of operation, we've got close to around 350,000 trucks on that platform. What we get in, what one can look at information coming in is a consistency of, the trucks getting deployed on that platform, the earning potential which can, is happening. Also, most of these platforms today have ratings around the vehicle, around the driver, around the owner. So you get a lot of inputs which are coming in from that side. Now, this is another layer which comes into when your decision making is concerned. The third part revolves around the asset itself, the truck itself. Thanks to a lot of this improvisations which have come on the technology side, including regulations. You have a well-established telematics platform in each of the new trucks which are getting deployed on the road, and you get a lot of information in terms of the mileage, in terms of the the distance covered, etc., which also gives you a surrogate comfort in terms of what is earning happening out there. And the technology improvements which have come in on account of a lot of these apps which track fuel mileage, tire mileage. You also have now chips which can track your driver behavior, addiction problems, etc. And therefore, that having an impact on operations is all adds on to surrogate credit formal inputs coming in, and that's how the credit assessment process is getting evolved further. So while it started off over the period in terms of having surrogate credit-based underwriting, now you are getting again not formal but semi-formal kind of inputs coming in, and that is kind of the rethinking of credit assessment is that process is now going on. It's a transition right now, but I believe over the period it will kind of reach where you'll have quite a bit of formalization coming in. But yeah, the risk is, as Rajiv rightly pointed out, therefore, it might then move, the movement toward from NBFCs to bank might happen much more faster if this, kind of happens. So that is a risk from an NBFC perspective. Now, coming on to the second point that you said in terms of volatility and asset, quality risk, obviously, you've mentioned that, it's highly cyclical, right? We all know that, and therefore, you have down cycles or degrowth cycles which come in that have an impact on your, portfolio. So, established commercial vehicle financiers over the period, conventionally, we all diversified our risk. That's the one step that we all have done, larger, whether it is geographical diversification, whether it is customer segment-based diversification, vehicle model, stored application-based diversification, etc., to ensure that there's not a single event that kind of, brings in a high amount of risk onto your portfolio. Over the period, also now, we all of us have now, evolved towards setting up our risk analytics, and now all of us have kind of, built up our capabilities to kind of, have the lead indicators being kind of monitored consistently. You have, one obviously top of the, this thing is your fuel prices, how it is moving. Then you're also kind of looking at segments where the vehicles are getting applied and the fortunes of those segments, maybe cement, steel, infrastructure. Principals who are there, state governments and, contractors, and how those repayments are going to come in. What it enables people like us is that, it's a preemptive kind of, action that comes in, a proactiveness which comes in for us to kind of not only forecast our risk and therefore, possibly take steps well in advance to kind of ensure that the collections and the portfolio behavior is kind of, in place, but also loops it, we kind of loop it back into the policy to look at how the new sourcing therefore can be aligned to, these kind of evolving risk. And the proof of the pudding is that if you look at it over the last 1 decade, minus of the COVID period, which I take it as a one-off exception, your asset quality metrics for large vehicle finances have largely been range-bound. So if you look at it right from whatever 2015, 16 till now, barring the 2 years in between, it's been largely range-bound, and I think it's a clear indication of these steps which have happened on the underwriting side, on containing the portfolio risk management, which is playing out right now.
Thank you, Sachin, for that elaborate explanation on that. Thank you so much. Now, my next question is actually common to all the panelists, and I would like to kind of all of you to answer that one by one. We can start with you, Kalyan sir. The question is common for all of you. The question is that looking ahead over the next 2-3 years, what is the one structural change, whether in data infrastructure, partnership, or regulation, that you believe will most fundamentally reshape MSME lending? And sub-question to that, is the industry fully prepared for it? So, Kalyan sir, we can start with you and then we can go
Yeah,
around.
thank you. Actually, for me, it is data infrastructure. If we correct this, then all other things which you mentioned, those are also very important. We will actually meet the objective if data infrastructure is created nicely. See, now we are having a ULI platform, Unified Lending Interface. When it was designed, basic purpose was like success story, repeating success story like UPI. Because as per discussion we all have observed, there are larger masses, there are digital footprints. And based upon those digital footprints, the credit history light files also can be, actually we can put them through credit underwriting process and can reach to those customers. So working on data infrastructure is very important. Actually, I will tell you from public sector mindset, I understand those people who are sitting here also on dais, that our approach, to be very frank, must change from collateral-based approach to cash flow-based lending approach. And if still you can see the where collateral are not mandatory, we say, and we always insist upon from senior level. So our transition from this mindset to means how much collateral you are providing to how your business are running actually. This shift is very much important. If we actually capture the businesses properly, when I am telling this, then starting from credit underwriting to monitoring to collection, and that structure data sets to be created in real-time basis around the cash flow. Successfully, if we prepare this data infrastructure, then certainly we can reach the objective which we are talking about. Then, regarding preparedness, if we talk about, see, account aggregator system, consent-based data sharing, this is very good step. ULI also, 66 lenders are onboarded there, double in 1 year. There are progress, but still, a shift in mindset, shift in data quality, shift in technology, these things are required. And I understand next 2 3 years, all organizations, including banks and financial institutions, must work towards creating this ecosystem of this data infrastructure and coupled by, supported by regulatory changes and also other important aspects will serve the purpose.
Thank you, sir. Sachin?
Yeah, I also will tend to think that the public digital infrastructure will play the most important role, and whether it is account aggregator, ONDC, or the ULI platform coming into play. It's obviously kind of brings in a structured approach towards consent-based information sharing, and will enable us to rewire our credit underwriting and also product design structures around that. Obviously, I think from a preparedness perspective, we all have our kind of, the journey has already started. We are at various stages in as far as lending organizations are concerned in terms of having the integration with this system, pulling out data and looking at building on credit underwriting assessment models around that. Obviously, this also involves a huge amount of change as far as your technology stacks are concerned, the upgradations happening on that side, looking at building on, along with the data and your captive data, AI models around that and deploying it as far as underwriting and policies are concerned. I think the larger change which is already happening but needs to possibly inch up is a human capability around that, the reskilling which needs to happen for people to kind of, looking at and, deploying this data stroke, the model outcomes and looking at how underwriting and, the policy, product designs can be much more sharper. That's something which is work in progress and, that would take possibly some time. But the good news is that all of us are on the journey and, you can see that refinements happening and which ultimately I think will kind of be resulting in an outcome which is to ensure that the credit gap that we are all talking is being addressed in a much better manner, and also taking care of what Rajiv was saying, the crook elements out there being flushed out of the system. So that's how I think the go forward progress might be.
Thank you, Sachin. Rajiv, your thoughts?
I think you're going to have unanimity on the panel on this particular
Yeah,
question,
looks
right? I think Ashish kicked it off, and both Mr. Kalyan and Sachin have only reiterated it. To me, the combination of ULI and account aggregator, if you're able to stitch it together sensibly, could be a UPI moment in lending. Not because UPI, which does instantly, we can do instant lending, but I think what it enables is for us to do a few things, right? One, it obviously brings multiple sources of data to ensure a very sensible underwriting decision that we're able to take, well-informed underwriting decision. But second, it also, in a sense, allows us to move from doing point-in-time risk monitoring. Like today, for example, we do annual stock inspections, or we will do quarterly customer visits to understand if the vehicle is there, is plying, so on and so forth. These are point-in-time sort of monitoring, right? We can now do continuous ongoing monitoring because we have access to so much more information, and that sort of strengthens the portfolio monitoring, risk management capability. And third, to me, it allows us to actually tailor solutions to the requirements of customers. You know, a transport operator who's flying perishables from Bombay to Nasik has very different cash flow cycles and requirements than a cement transporter who might be going from Madhya Pradesh to Delhi. You know, you get the point. There's very different cash flow demands that multiple of these subsegments have, and you know, this kind of richness between ULI and account aggregator allows us to create genuinely almost personalized solutions for every customer, and that to me is a very powerful capability. Now, to pull all this together, I think obviously data infrastructure needs to fall in place, partnerships need to fall in place, and most importantly, regulation needs to enable it. The way I think the Reserve Bank is driving ULI, and we've been involved in a few pilots that they're driving, they are really committed to making this happen. So I feel very optimistic that ULI will take off, and if we as market participants can combine ULI with account aggregator, I think it could genuinely transform. But again, it sounds very exciting, but there are all the risks that I highlighted before, right? It's not just about underwriting. It is about ongoing portfolio monitoring. We do have to ensure that data privacy is managed and maintained sensibly. We do have to ensure that the guardrails around who approves, who declines, what kind of monitoring is in place needs to be enabled. So there are a number of things, and frankly, data availability itself is still evolving and patchy, right? For larger entities, that the data is robust, but you had a presentation on how thin files you're extracting intelligence from. There's still a large base that is still in thin files, and how we will extract that intelligence still remains an issue. So I think data access will get licked. I think model sort of sophistication and governance we will ensure falls in place. But this notion of portfolio monitoring and intelligent risk management, to me, is a big question mark still, and that's probably one of the biggest risks as an industry we'll have to solve for. So I would frame it as, is the future digital lending? Likely not. I think it is digital risk management that we have to get behind. And if we can frame it that way, I think we'll end up doing a lot of good collectively.
Super. Thank you. Indrajit?
Nikhil, you might regret asking me this question. You know, for MSMEs, see, CIBIL has a score for all of us. And market determines how much they will lend to us, at what terms, what rates. The question is, what structural change should happen in the next 2-3 years, which will be beneficial for MSME? I'll start from the cross-border, which I was speaking about. You know, what we need to do is extract data of all the transactions the MSME does, whether it's an export or an import, and store it. But that I'm just limiting to lending products. What the importer pays as a simple payment offshore should come into this model. The importer is fulfilling his obligation for payment. I think by now Nikhil knows where I'm going. So we request a scorecard from CIBIL for all our MSMEs in India. That is the ask. I'm aware true under its brand True Value, has come out with a commercial scorecard on a score of 1 to 300, pretty much like a retail scorecard of up to 900. But this has to be attuned to the MSMEs of India. And if you can actually succeed in doing that, you would be doing an absolute UPI moment for India. Thank you.
Thank you, sir. Thank you for your feedback. Ashish?
Thanks. Since what I said has already gained momentum, let me try and flip and talk about two big pieces. When we looked at enabling credit, I think the supply of money becomes important. And if a lot of the credit going to come through at the point of transaction, this means the securitization market has to evolve. I remember us doing a first few supply chain finance securitization way back in 2019. And then every year, we almost do $500 million worth of supply chain finance securitization. And I think it's a powerful liquidity tool. I think the second most underrated, I know I shouldn't be saying, but I think the evolution of India's fixed income market. To me, that will be a game changer. If you look at it globally, the fixed income markets in most of the countries is 3 to 10 times the size of capital market. In our case, it's about 1/10 of capital markets. And, you know, for the nature of work we do between origination of retail credit, underwriting, investing, and, you know, entire piece, we run performing credit funds. And we ran 2 funds on the startup businesses, small businesses. They've done really well. They give you an investor 13.5 to 14% returns, a fabulous place. That's the best way to provide 2 to 3 year money to the institutions where banks are not lending. And I think that market will create much needed gap which exists between the transaction-based financing, the bank giving term loan, but a pure structured credit for the smaller businesses, correct? I think that will be one big play for us. So bonds market and securitization markets will provide both, one, the raw material to the lending institution, second, a challenger to the lending institution if the fixed income and the funds start becoming. Today, if you look at it, it is now becoming a big port of call for people to raise money. It is the transmission of interest rate has happened faster in the in the NCD issuance by the non-bank finance companies than by the change in the rate. I mean, that transmission is less than 10, 15, 25 basis point, but on a similar rated entity is able to raise money now at almost 100 basis point lower from public. So I think we'll see that a big game changer as we go forward there.
Thank you, Ashish. Ladies and gentlemen, the screen is also showing time's up. I think there were absolute pearls of wisdom that we heard over the last 45 minutes from all these legends of the industry. I think there were different diverse perspectives. There was a cautious optimism. There were bullishness on various things. But one thing is clear that I think MSME lending will be shaped by the combination of innovation, collaboration, and responsible credit access. So I think, so I just want to thank my panelists. Thank you all for being patient here, listeners here, and thank you very much.
May I request all the panelists to stay on stage? May I request Nikhil to share a token of appreciation for Mr. Kalyan Kumar? Mr. Sachin Pillai. Mr. Rajiv Lochan. Mr. Indrajit Kamotra. Mr. Ashish Mehrotra. Thank you, Nikhil. I'd like to take a minute and thank our panelists for such a rich and insightful session.